A very good morning to my dear children. Today, in our online class, we would be doing factors affecting capital structure. But what is capital structure? Capital structure means the composition or makeup of the amount of only long term funds because short term source of finance are never a part of capital structure. Long term funds is divided into two parts: owned capital and borrowed capital. Owned capital constitutes first share capital and second retained earnings, whereas borrowed capital constitute first debentures and second long term loans. Therefore, capital structure involves two basic decisions. First, type of securities to be issued or raised, and second, relative proportion of each type of securities. The first factor which affect capital structure is trading on equity. What does trading on equity mean? When a company raises capital not only through equity capital but also by the issue of borrowed cap funds, then a company is said to be trading on equity. But when or on what conditions a company can trade on equity? A company can trade on equity when the rate of earnings is higher than the rate of interest and the rate of preference dividend. Second, the company's earnings are stable and regular to pay at least the interest on debentures because interest on debentures are fixed and have to be paid irrespective irrespective whether the company is earning profit or is incurring losses. Last, there are sufficient fixed assets to offer as security to the lenders. Second factor which affect capital structure is exercise of control. A company can raise funds by issuing equity shares. Equity shareholders have voting rights. Voting rights means that they have power to participate in the day-to-day activities of the company. But if the present governing body does not want does not want interference of shareholders in the participation of the working of the company, then it is advisable or desirable for the company to issue to raise funds through preference shareholders or debenture holders. Third factor which affect capital structure is need for flexibility. It is preferable, it is preferred or it is advisable for the company to have a capital structure which is it is advisable or preferred that a company should have a capital structure which is inelastic and must permit changes in the future. That is, it must be flexible. For example, initially means in the initial stages, a company may issue equity shares, but when company wants to expand or modernize the company, then there must be adequate conditions that it can raise funds through preference shares or debentures. Fourth, nature of business. Nature of business determines the relative proportion of different sources of finance, that is, owned capital or borrowed capital. The quantum or amount of funds depend on the scale of operations of a business enterprise. For example, a large enterprise would require more funds than a small enterprise, whereas a new and stagnant means which does not change, firm may find it more difficult to issue debentures and preference shares than a well established company because debentures and preference shareholders have to be given fixed rate of dividend or interest and has to be given has to be given yearly even if the company is incurring losses. Fifth, cost of financing. Cost of financing means that how much expenditure a company is incurring to raise funds. And expenses includes rate of interest, return expected by investors, expenses and other administrative expenses. In a good financial structure, a cost of capital should always be low. For example, cost of debt is lower than that of equity, which means that when you raise funds through debentures, through borrowed capital, the cost is comparatively lower than raising funds through owned capital. Therefore, it is advisable that a company should estimate and compare the cost of alternate source of finance before making a choice among them. Sixth, period and purpose of financing. A company requires funds for permanent investment, expansion, modernization, etc. Therefore, when a company wants fund for long-term purpose, it chooses equity shares or it can choose retained earning. Whereas when a company wants money, wants fund for short-term purpose, then it can raise funds through preference shares, debentures, or loans. Seventh, capital market conditions. Capital market conditions refer to the state of capital market, which influence the choice of securities to be issued. That is, during boom, investors invest in equity shares because they are ready to take risk, whereas in depression, investors invest in preference shares and debentures because they want safe return on their investment. Eighth, statutory requirement. The Companies Act, SEBI guidelines, and other state regulations a company has to observe while raising funds from the public. For example, banking companies are prohibited from issuing any type of securities except equity shares. Ninth, need of investors. All investors do not have the same attitude towards their investment. For example, people or investors who invest in debentures are they are highly conservative investors because they expect safety of the return. Investors who invest in equity shares are the ones who are ready to take risk and therefore they get high return. Whereas investors who invest in preference shares are the one who opt for limited risk and therefore they get reasonable return. Last heading is cash flow position. Cash flow position is basically the ability of the firm to generate enough cash flow, that is revenue, that which affect the capital structure. Therefore, a company should have sufficient cash that they can not only cover fixed commitment, that is fixed commitment means that they can pay dividend or interest, but there must be sufficient buffer or profit for other or unforeseen to meet unforeseen activities.